Welcome to the OPEX Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kachuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility.
So Brent, I feel like kind of a broken record at the beginning of these things because we just always talk about how the market keeps going up. And it seems like this week we're going to do the same thing because the market just continues to go off.
It's an incredible feedback loop where, the higher prices just draw more people in and, onwards and upwards. It's just the path of things these days.
So this time Brent and I are just going to talk about UConn's chances in the NCAA tournament because all this turning point stuff is all a waste of time. So we're just going to, we'll skip the options. I mean, the YouTube engagement stats will probably go down, I would assume, with us not talking about options, but I think it'll just go that way this time.
I'm optimistic for the first time in a while.
I am too. Last year kind of came out of nowhere, but this year they're a solid team. So hopefully it keeps going.
I'm with you.
We're not actually going to do that. But as we get into the options stuff, for people who haven't seen our previous episodes, we always like to talk about the options cycle and how it works first. So could you just go through, you've got a great slide here about the OPEX cycle. Can you just talk about how it works?
So the way that we look at the options market and positions and the way it impacts the market is on a cycle. And for general purposes, we look at it on a 12-month cycle, and the third Friday of every month is an options expiration or a big options expiration. And so typically the way that we look at it is after that third Friday expiration, positions start building at the next third Friday expiration. That builds up hedges that are associated with those positions. And then those positions build and we kind of hit maximum impact the week before expiration, which would be this week. And then positions expire and we start the cycle again. There's a larger cycle there tied to the quarterly expirations as well, which is obviously March is a quarterly expiration. So we think those positions are a little more large and meaningful. And if you look at this chart, each red X is an individual expiration. So this is every monthly expiration. And there are these times where the positions grow to be very large in size. And we think that the associated positions, hedging positions, related to those options are larger as well. So, we always talk about March of 2020, where the low of the market was the day after options expiration. You could look at June of 2022, and I think it was September of last year, where oftentimes it's these big put positions that expire, and then the market will rally after that. And occasionally we see really large call positions build up as well. And when those expire, we see short-term weakness in the market. And I have some stats to talk about this later in the presentation.
Yeah, on this next slide, you talk about this zone. And this is something we've talked about a lot, is where, positions sort of build up in these specific zones. And it's a different zone every time, obviously, because the market's moving around. But can you just talk about what you're seeing, like in this 5,100, 5,200 range?
Absolutely. There's a cadence to the way that positions build, and this is the SPX, but it overlaps with the spiders. And a lot of people kind of wave their hand at the size of spider positions because they think it's retail oriented, and there is a lot of retail flow in there, but the positions can be very large. And when you look at the hedging flows associated with those, notionally, they can be the same size. So when you look at 5,100 SPX to 5,200 SPX, you can see the size of call gamma here in orange and put gamma in blue. And you'll notice there's three big bars. It's 5,100, 5,150 and 5,200. This does not show the equivalent positions at spider. So, 510, 515, 520. And what happens in relation to that cycle we were talking about, the gamma at these strikes grows, and the gamma notional, which is what we're plotting here, in theory is related to the size of hedging flows that work around these positions. So shares being bought and sold or futures being bought and sold. And what you tend to find is, and again, we'll talk about this in a later slide here, is that the expiration tends to unlock new levels in the S&P 500, and you'll see some evidence for that shortly. And it's because I think these big positions that grow at these strikes, they get erased, and that allows the market to kind of untether from these areas and move away. And last, I would just note, you see that 5,000 strike to the downside. A lot of positions tied there. There are a lot of spread positions actually funding trades there, but there's a lot of activity that is at that strike as well. And so again, we're approaching March 15th. A good 30 to 40% of the strike size at these strikes here is going to be wiped away on Friday. And again, that should mean that the positions or that the market untethers from this area and we shift either higher or lower to be determined.
Two questions on this. What should I think about the balance of this? I mean, they seem to be pretty balanced, the lines, other than the one way at the top. which seems to be more, a lot longer on the top line. Like, is there anything I should take from that?
Yeah, I think it has to do with how people add positions in the indexes. And so typically we model that. Generally, traders are long stock. I have a 401k, you probably have one or whatever it may be. We're all long stocks, and there's a lot of call overriding. That's a huge topic of conversation now, these structured call overriding funds, for example. And what happens is the market moves up a little bit, traders tend to sell calls into that. Or let's just say you buy some out of the money calls. But the point is you're trading calls at strikes that are above where the market is trading. So 5,200, you'll notice, is purely, that's our call wall level, which is purely call positions. It's only an orange bar. There's no blue there. And that's because when the market moves up, it's call activity that's trading, slightly out of the money call activity. And that builds up overhead. Again, we think here that this happens to be mainly call selling. And then what happens is on the short dated basis, like this week, people will sell the Friday option, for example. They'll sell puts below. So we were almost at 5,200 on Friday. We rejected that level and came down rather violently. And then people started to sell puts below at 5,150 or at 5,100. And that adds to the put gamma, those blue bars that you see below. And so generally speaking, we think the larger these positions are and the more neutral they are, the more kind of pinning flow or the more sticky these areas become. If you were to see, a giant blue bar below, I think that's an area where we'll tend to see a lot of volatility, for example. So the way the positions are added, there's a cadence to them. In theory, what will happen next is we'll move up to 5,200 after FOMC, assuming nothing, there's no hawkish tilt there. And then we'll see 5,250 or 5,300 build up in call positions. And then people start to sell puts at 5,200. And you'll see that orange bar 5,200 neutralize, right, become more puts. And the whole structure will shift up. So, we could be talking here where my last slide deck was at 5,000 to, 5,100 when we did this last month. Now we're going to be at, 5,300, 5,200, 5,000, right? So it's just the range slides higher.
So is the idea if we came down to 5,000, we would see that as like a significant support level because of all the activity there?
There's a lot of hedging activity that should be invoked. I think at that level, there's a lot of positions there. It's a big psychological level. I think just anytime you see big round numbers, traders will look at that as support and resistance. And so the theory is that there should be a lot of hedging flows unlocked at that area, which means, people will monetize their puts, they'll add new positions, they'll shift things around. And that should, for this week, this is the week of March 11th, add some support. And then, next week we turn to the FOMC. So there's a little path dependency, that could shake out moving forward. But to your general point there, I do look at that as a large support level, and that's something that we make note of in our daily research pieces.
On the next slide, this is one we do every time, this options and volatility slide. And one of the things I've noticed, and correct me if I'm wrong, but I do think we've slid a little bit to the left here.
100%.
We're a little bit lower gamma, we're a little bit higher volatility. So it seems like maybe we're moving a little bit in that direction. Is that right?
Yeah, you're absolutely right. We were around the 1.5-ish area in the last month. This month we've moved down now. So we're just under this 1 on this chart. And what's interesting about this is that what we do here is we calculate the amount of gamma in the S&P 500, and we found that helps to forecast forward volatility. So basically what the gamma reading is today can help us forecast what volatility will be tomorrow. And this is tied to how those positions build up. But what you'll see here is that if we just start moving a little more to the left on the gamma positioning, volatility really starts to increase. So how do we get a lower gamma index? You reduce call positions or you add puts. Either one will shift this gamma reading to the left a little bit more on this chart, which tells us that there's volatility around the corner. So if the S&P slides a little bit lower, kind of in the 5,000s, we're just above 5,100 last time I checked, and or people start buying some puts around, Powell coming up or CPI, or whatever it may be, that's that area where things can get squirrely, right? That's where you start to see daily moves of 2 or 3%, like real big sell-offs. So we're at that cusp or that precipice here going into this expiration. The other thing that could shift us here is that we're going to lose a lot of call positions with expiration here. So the removal of those calls could in and of itself reduce the amount of gamma in our readings, which really primes us to have a very volatile environment. And so, if you're thinking, hey, is this a scenario where I need to maybe hedge my portfolio, buy some puts, whatever, maybe my answer would be yes, based on our data and our research. This is an area where things can get kind of messy. And to that point, the VIX has snuck up. It's around 15. Some of that is CPI tomorrow morning. And then, we have a range of catalysts that come up ahead of that as well. So, this is a very interesting moment in time here for markets.
We're going to get maybe in future OPEX effects here. We're going to get some excitement. We're not going to be using like titles like record low volatility on YouTube and stuff. We might actually get a little bit of movement here.
Well, it's there's a bunch of things that correlate to, something is about to happen, right? And there's been a lot of realized volatility in single stocks. There's a bunch of information suggesting that's kind of breaking apart a little bit. Our gamma readings are sliding down. We have plenty of catalysts coming up in the next week. I mean, a slew of them. And there's been a lot of this energy in crypto and Nvidia and all these other that have really stretched things up, right? And so that energy's gotta, go somewhere. And I think when you really, like pulling the rubber band back, like you let the rubber band go, it doesn't fall on the ground, like it slingshots off. So I think that we're really at this very, very stretched position in a lot of different metrics. We'll be talking about here in the next couple of slides, but this is a time where, some consolidation, some mean reversion, like, like in February, you feel like, this is getting a little stretched, it's getting a little weird. Here you go. Okay. Like we're, 10 out of 10 stretched, and there's triggers finally. So again, it resorts back to this idea that it's a very interesting moment in markets.
So let's talk about the next slide. What's coming up here in March? The expiration.
So let's start with the size of positions at expiration. Here in the purple, you see call positions. And what we do is we measure delta because it basically tells us the size of the stock notional equivalent. And, this is hundreds of millions of dollars of single stock call positions that have gained in value over the last 4 to 6 weeks. And this is a very lopsided position, meaning that this is all calls that have accrued. That's probably not surprising, right? Because all the semi-chip stocks have rallied so much, crypto stocks, broadly the market's up. So there's a huge call imbalance. These are short-dated calls that have built up. And I think when you get these imbalances and they expire, it often leads to mean reversion in stocks. Now, we saw a very large January expiration. The difference between the January expiration, which had a ton of calls, and this is that those January call positions were leaps. They were positions that were in place for a very long time. These were call positions that have largely accrued in value over the last couple of weeks. It's a lot of speculated short-dated order flow. And there's a bunch of other signals that show us that that things are really too far skewed to the call side of the equation. This is an order of magnitude larger than what we saw in December, which was the last pretty large options expiration as well. So this is a significant options expiration in terms of size. And in theory, the removal of these calls could do a lot to stall out the momentum in the markets. And we have some data that suggests that momentum tends to stall the week into expiration, not necessarily the kind of days after. And I can touch on that as well.
So is this similarly call heavy? I think like January was pretty call heavy. You mentioned the leaps. February was call heavy as well. Is this like a similar ratio here, or is it getting more call heavy?
This is an order of magnitude bigger than February. And it's about double that of the December expiration. December's always one of the bigger expirations of the year just because it's the year end. So, we're talking about a significantly larger, by all metrics, 2-3 times, depending on the name you're looking at, if not up to 10x more than what we saw in February. Again, depending on the name and the sector you're looking at, because the semis are, and as we'll show in data, the semi stocks have really just blown it out of the water here over the last month, really.
How about like the ratio, like outside of the size, like the ratio of call to puts, has that been kind of similar, or is that getting more extreme as we go?
This is about as extreme as it gets. So, you're talking, 4 to 1, 5 to 1 calls to puts. And this is measuring specifically individual single stocks. If you look at index flow, it's about the same ratio as well. And so if nothing else, you can look at this and say, well, everybody's in calls right now. Nobody's in puts. The problem is that historically people tend to buy single stock calls, and it's not that unusual to see a ratio like that. It's unusual to see this magnitude in terms of how big the numbers are, right? You generally don't have, billions of dollars of single stock calls set to expire. into an expiration, right? Typically with the monthly expirations, that won't happen. With the quarterlies, where this stretch because of how hard the market's rallied, this is a really rather significant event.
So one of the things we always do here at the OPEX Effect is we hold ourselves accountable from what we talked about last month.
Yeah.
So yeah, can you just talk about what our views were, going into February and how that kind of played out?
Anytime there's a bad call, I try to blame it on you.
Yeah, you should. I have no idea what I'm talking about, so you can definitely throw the bad calls on me.
So it was all Jack's fault. But there was two things that I took out of our conversation from last time, was that we were looking for some consolidation in the market because there was kind of like today, although it was an order of magnitude arguably lower, not just in size, but in vols and everything. We were looking for consolidation after February OPEX. And then the second thing was there was these really concentrated call skews. People were very piled into calls. And if you remember, we were almost into Nvidia earnings. And so we were saying like, look, this is a time for some consolidation here. And the issue is we're about to go into Nvidia earnings, and Nvidia just blew it out of the water in terms of their earnings, right? And that really ignited a fire in the market. So what you can see here is that we recorded on Monday, which was before CPI, kind of like this month. And there was indeed a consolidation, all of 1.4% in the S&P, which qualifies actually as a significant retracement this year. I don't know if you're aware of that, but 1.3% is
that's a massive.
It's like
decline,
a 6
right?
standard deviation sell-off in 2021. But it's so funny because you see the market pull down here, and then Nvidia earnings. So Monday was weak in the markets, and then I think it was Tuesday was when Nvidia earnings were, and then Nvidia just annihilated it. And it rallied, and all tech stocks, all everything gapped up significantly after that. And then, we were kind of off the races here. That incidentally, the S&P, the S&P into February options expiration was at 5,000. That was a big strike we highlighted. Now we're at 5,100, right? We just keep stair stepping 100 handles every single expiration. And so, now we're at 5,100. I think Fed could probably pop us to 5,200 in a second, maybe even CPI tomorrow. So we're just going to keep maybe stepping higher. But what's also interesting about this expiration was we had the Nvidia product announcement on Monday, which a lot of people are paying attention to, and I'll qualify that or quantify that maybe a little bit in terms of the implied balls that we're looking at. So related to that was this idea that there was these, I call them heavy call skews, heavy call game. It's all heavy because it's just big. In this case, we ranked what we call our skew rank. Skew measures implied vol value of calls versus puts. And what you can see here is there's this kind of blob, and the yellow blob was at the bottom right of this chart, which shows us that people were very into call positions. Significantly, this ranks them. So we were at 90 percentile rank across most large stocks, stocks with heavy options volume. So everybody was, into calls into this position. I listed in this chart all the big, semi stocks, chip stocks. They all had huge call skews. The Mag 7s all had big call skews. It was like an extremely bullish environment. And then what happened was you threw Nvidia gasoline into that fire, and then, just bam, stuff just accelerated, right? And there was just a lot of massive upside. So we've now shifted higher in this single stock space as a result of those elements all combining. And we are now here, I've been using the analogy that if you've ever watched like the Virgin Atlantic, like rocket ship, it takes people up into zero gravity and then they like float around for a minute. And then they come back to Earth. Like, I think we're in that zero gravity moment. Like we're all floating around. Like we've been on the call rocket ship and it's running on fumes, and we're going to have to like, consolidate a little bit here, right? Like return to atmosphere for a few minutes. And I preface this with saying that I think we're headed for a top. I don't think we're headed for the top, even though my specialty tends to be 30 days out in time max. So, I'm not trying to stake my flag here saying that this is the top of 2024, but it does seem like it's a short-term area for some retracement.
Yeah, the Nvidia thing has been just shocking to me. Like the ability, we kind of showed it last week or last month in the options. The expectations were very high, and you saw that like in the numbers too. But they're just like blown. You'd think like that's a setup for disappointment, but like the revenue growth and everything, it's amazing. Like the numbers they're putting up are just so off the charts that like it's just beyond anything anybody can expect.
Yeah, I mean, I think you can say that it's undervalued just in terms of, I mean, there's a lot of forward PEs that people are posting on it. And same thing with SMCI, which was one that, has gone just tenfold in this year, I think. And, now it's added to the S&P 500, which is a fascinating thing as well, that chip stock. So, I'm not here to talk about the value of a name or whatever it is. I am here to offer some opinions on the rate of change. I also think that, I thought about this a lot in that so much of what happens in markets today is all just a momentum trade. And, there's so much behavior now that's I'm going to buy the stock because stock goes up, as opposed to like, I think there's long-term value here, right? There's so much chasing, like in Nvidia, for example. I didn't know this till Friday, but there's an Nvidia 2X levered ETF. That's all they do is they double lever. And there's also a 1.5 levered Nvidia ETF. Why do you need both? I don't really know. Do you care to guess what the AUM of that Nvidia 2X
I remember
ETF
it was very, very large, but I don't know the exact number.
It's $1 billion.
That's crazy.
Now, some of that is because Nvidia's gone up, whatever, 200% or something in the last 2 weeks or whatever. But, the point is the same. It's like, that's just the levered ETF space. Nvidia is now itself of the SOX ETF, semi-chip ETF. It's now, it's larger now than the other 30 components of that ETF, Nvidia's. And then, interestingly, the SOX ETF also split this week, which I thought was curious. They announced a split in December, but, when I was like, it was funny because I was reviewing the 2021 data for a minute, and there was this big high in August of 2021 that ended the day, like Apple and Tesla split on the same day. And that was the day like the market had a really violent retracement. And I was thinking about this idea of stock splits, and I have to backtest that at some point. But at any rate,
I would wonder, like with the Nvidia ETF, like how many of the people that hold that, or institutions who are sort of thinking about intelligently using it, like sizing it properly and stuff, and how many are just the YOLO, like, individuals who are just saying, all right, Nvidia does nothing but go up. Like, I'm just going to throw all my money into it or something.
It's a fair question. And like on Friday, there was a really ugly sell-off. Nvidia in the morning went from, up to 980 area, and then it just completely tanked. It was one of the largest options selling flows in a single stock I've ever seen on Friday afternoon at Nvidia. And the stock, I think, it was up around 980 and it closed in the high hundreds, I believe, and it's having a little bit of trouble today. But that Nvidia double levered ETF lost from its high to its low, I think 20% on the day. And it's still up 160%, I think it is, for this year. But the amount of volatility in just that thing, and not to mention the fact that, this is the third largest component of the S&P 500, and it's trading like a meme stock. And I think that's really rather fascinating because there are all these index flows that in theory should throttle the volatility of that thing, right? And it just doesn't seem to be happening. So, these are signs of instability, obviously, in the market. I mean, there's no secret about that. And everyone likes it when the instability is, projected in the north region, meaning like stocks are going violently higher, like everyone feels great. But if and when that flips, I mean, invariably we have some big drawdowns, right? And then suddenly it's like, well, let's have investigations on all this crap that's going on. Well, like the time to figure out why we need a 2X Nvidia ETF and a 1.5X Nvidia ETF is like, let's think about that now, right? Because the other problem is, related to this is like, there's a new ETF launched every day now that sells, zero DTE options. And, there's a lot of conversations around the structural issues around that as well. So, the financialization of markets here is, this is totally outside the purview of what we're talking about, but,
no, and to your point earlier, like one of the things that as a fundamental guy that got me into like this whole options flows thing is there's so many, you could definitely argue like the percentage of flows in the market that relate to fundamentals is significantly down over time. Like the percentage of flows that relate to other things is up a lot.
Yeah.
And so you see a lot of the movement in these companies, and, a lot of fundamental investors believe, fundamentals don't matter as much anymore because you see so many of these other things driving like these stock prices around. And so it's really interesting to get under the hood and understand what those things are.
Yeah, I think that's, I mean, it's a great point. 50% of the options volume now is 0 DTE or tied to the next expiration, depending on what you're looking at. You see the size of options flows trading every day is just, they're momentum trades related to some stat arb strategy or whatever it may be. Dealing with an extended trading view of from 9:30 to 4 p.m. and that's really it, right? And I think when a stock sells off a lot and there's a value proposition, you see some money come into that. And then, when you're talking about how fast things can go to the upside, they really untether from reality. I think it's hard to argue that. I mean, if you look at MicroStrategy, which is the Bitcoin ETF, I've been saying this because I just think it's amusing. They're famous for owning MSTRs. They own 193,000 Bitcoins. And that's why everyone knows what the company is or has heard of it. It's outpacing the gain of Bitcoin. I'm going to screw this up, but you get the general idea, like 10 to 20x. So like if Bitcoin goes up 1%, MicroStrategy is going up 10%. And the stated purpose of the company is they sell business analytics software, right? That's, if you go to their webpage, that's what they're trying to sell you. But they own this Bitcoin. And so it's bizarre because it's almost like a SPAC, but it also just goes up at the rate of change that it goes up is completely untethered from the Bitcoin that it owns.
It's become like a lever proxy for Bitcoin, basically.
It's a lever. It's exactly right. Very eloquent.
Right.
Yeah. Much better said than I said it. And I just use that as an example because like if it was going up with the pace of Bitcoin or like 2x Bitcoin, you go like, okay, I guess it kind of makes sense, but it's not. It's a magnitude higher than the Bitcoin returns. And it's really pretty wild to see. So at any rate, the semis that you can see here, this is SMH. It's had an incredible year. And, we used to have FAANG, then it was like FAANG plus TDAD, Tesla, then we had Mag 7s. And now look, the only thing is chip stocks. That's the biggest driver of the market. Apple and Google actually have not been doing very well. They've been sputtering. As at Microsoft, you could argue, Amazon's kind of doing okay. Meta is the only really kind of non-Nvidia Mag 7 name that's doing okay. It's had a pretty good return, but some of these other names like, Berkshire dumping Apple and it's had a lot of problems. Google's had problems with their AI. Those stocks are not performing that well. So literally we're holding on to crypto and chip stocks. There's some overlap there, I guess, but this is another thing that's like, okay, like what's going to take us to that next level? Maybe it's generative AI that Nvidia announces on Monday, or I don't know, but we'll see. Can't count them out of anything at the moment. So
this next one's really interesting. This you looked at the forward returns of the SPX relative to Bitcoin trailing returns.
Yeah.
What did it say?
Well, I did this recently in very short dated returns, and the returns of Bitcoin, it was like on a 1 day basis. If Bitcoin's up like over the last day, the 5-day S&P returns tend to be high. So what I did here was I looked at the previous 5-day returns of Bitcoin and said, if it's positive, just, give me a little histogram here of the forward 1 month returns, essentially the S&P. And as you can see, there's a positive skew to these returns. 50 basis points is, kind of what I would say is the mean of this. And, so that's the environment we're in. Bitcoin's going crazy. I'm not here to offer the macro thesis for why that is, but just when you look at Bitcoin as a proxy for risk taking, which I tend to look at it as, it shows you that people are willing to step out of the risk spectrum in this asset. And is it changing into a different kind of asset, an inflation hedge, or maybe, I don't know. But I just generally think if Bitcoin's going up and like all these other cryptos are going up, the name of the cryptos now that come out are hilarious. I can't say any of them on the podcast here, but go and look some of them up. They're extremely inappropriate, but funny nonetheless. And they're all going up at 1,000% a day.
I have to learn how to do censoring in the editing, which I have not learned how to do yet. So I appreciate you not saying this.
Yeah, it's pretty amusing. So, there's a ton of risk appetite out there in that space, which ties in this. So the other one that's breaking out is gold. And as I'm an old man in waiting, meaning I love gold and I like, historical coins and things like that. So whatever, gold is finally broken out from this quintuple top, I guess that it was around 2050, whatever it is. It's breaking higher. And so Jeffries posted this chart I caught, which shows you the forward returns of a 5% 1 month rally in gold. And everyone's saying, well, this doesn't have anything to do with options, but I still just found it fascinating. So here's some extra value. And you can see over the short term, the returns are somewhat noisy, but look at the forward 3 month and 6 month, 12-month returns of the S&P. They're all up from 2.5% at 3 months to 8% at 6 months returns. 70+% of the time, the S&P is positive after you see something like this. That's an impressive correlation. And you overlay that with this Bitcoin. My stats are a little more loosey-goosey than what Jeffries provided, but the point is the same. These two things screaming higher generally speak towards positive returns in, out in time a little bit, right? And so I just thought that was fascinating and needed to add that little segue in.
Yeah, I wouldn't have guessed that with gold. I wouldn't have guessed like the S&P's up that percentage of time when gold's up.
Yeah.
I would have thought gold would be up maybe more in periods where the S&P was going to be, a little more questionable.
Yeah. And if you look at gold, it made it did pretty well in the second half, I guess the early part of 2022, which when that market S&P really fell apart. And then it really fell down in the second half of 2022, which is when inflation spiked. So I think anyone was thinking that it was an inflation hedge, was convinced that it wasn't the case in 2023. So why are gold and Bitcoin both going crazy right now, and stocks are going crazy? It's like all assets are going up. I don't know much from the macro perspective, but feels like there's a rate cut joke that should be embedded in there somewhere.
Insert it after the fact.
Time to cut rates.
Love like Brent in a different shirt, but inserting the joke that he comes up with later. So this next slide, you got at the edge, the degree of the chasing that's going on, I think is what you're getting at with this.
Yeah. So now we're moving back to the option stuff. So macro Brent can go take his seat in the corner. This is a chart, and it comes from the OCC Options Clearing Corp, and they tell us whether options are bought or sold on a weekly basis. So this is their data. They're kind of like the quasi-government clearing institution. And what you can see here is that this is single stock equities buy to open premium in blue, and it has gone vertical over the last week or two. And it's nearly taking out the 2021 high. Now, November of 2021 capped off like the craziest speculative period that I can remember. It was the culmination of GameStop from January 2021, the Tesla mania, stock splits, like, oh, this is just insanity. And we're now in a premium bought basis just under that November high. What's interesting about this is that on the bottom right here, I have options, equity premium. These are the calls that are sold to close. So what this is showing us is that there's a humongous amount of calls being bought. There's a humongous amount of calls being sold. That tells me there's a giant amount of speculative day trading activity taking place. This is also categorized by entity type. So this is not market makers. This is not dealers flipping stuff around. This is retail and or hedge funds. They're both classified in the same, they both have the same classification in this data. So it's pure speculation. If you saw calls being bought like off of a bottom and not being sold, you go, oh, people think that this is value being unlocked, like the market's at a low, they want to buy the dip. This is not what this is. This is a lot of speculative behavior and stock values increasing significantly. That drives up the premium being bought and sold. If you look at this on a contract basis, the magnitude is a little bit more constricted, meaning, we're measuring on a contract basis. You still see us closer to, 2021 levels. But the premium to me expresses also the fact that stocks are going parabolic. So the value of these are going parabolic. And there's just a lot of just flickering positions back and forth, right? And that's pure speculation. Back to our original point about, so much of there's so much financialization in this market, and it really rears its head during these times of kind of froth, I guess I'd call them.
So this last slide before we look forward to what's moving this time, this is something you've talked about in previous episodes, this whole 2021 comparison. Is that what you're getting at here?
Yeah, the reason I highlighted this is because when you look at 2021, you remember there was the meme mania, and then there was the crazy Apple Tesla split. That was like on, August 29th, I think they split. Like September 1st, somewhere in that area was like when these stocks split, and that led to a big drawdown in the market. And, I think now we have the other takeaway from this chart is that the dips in 2021 were often violent, but would last like a day. And it became like this rolling joke of like, oh, great, market's down. It's just this like value has been unlocked so I can like buy it. And, people would joke about the returns of just buying the 0DT calls anytime there was a red day, and then the market would go back up and you would profit. And that, I feel like that's the environment we're in now. And, I don't want to wade back in the macro again, and I don't know anything about, rates and policies and yada, yada. I am in the camp though that fiscal and monetary policy is probably going to at least be fairly neutral to benefiting, the incumbent in this election year. That's call it a conspiracy. I don't think it's that crazy of a notion. I just don't think like anything that crazy is going to happen before an election. So the idea that we're going to get some kind of restrictive policy or something that's really going to stamp this out feels, I don't know, maybe unlikely. So at any rate, this reminds me a lot of that period, not just because of the size of the volumes, but, what's going to stop the behavior? Like what breaks the cycle of speculative activity? Like threatening a rate cut probably would, right? Or like a bank failure or something. But, that stuff seems to be all getting bailed out right now. And I think fiscal and monetary policy seems to be accommodative to higher asset prices at the moment is my general.
Yeah, well, it's interesting too. We just did an interview that I just finished like an hour ago with this guy, Doug Clinton from Deepwater. He works with Gene Munster there, like a tech, hedge fund type thing. And like, he has this thesis that basically we're at maybe like inning 3 or 4 of an AI bubble that will eventually be bigger than the .com bubble. So again, you never know if that's going to play out that way. A lot of the world could play out in a lot of different ways, but it's just interesting to think about that. Like, given where we are, like this could, talking about going through the election and stuff. I mean, this could get a lot bigger than it is. And that's the challenge with these things is you can never, timing them is very, very hard. Like timing when they're going to end is very, very hard.
Yeah. And this is why I brought up at the beginning, like a top is not, the top. And you have these violent rallies that can, violent declines that could take place in the face of these, equally massive rallies. And, those dips tend to get bought. And, what's like, this is a behavioral aspect of trading that you have this buildup of these flows and everyone's piling into these 0DT flows and it keeps working. And there's a lot of FOMO, like, oh, I missed the dip in Nvidia last week, but now it's down 5%. Like I got to get in now. Right. And there's that. It's like, what breaks that behavior? In 2021, it was the clear shot across the bow that, rates were going to go higher. I think that the smart people sniffed that out and that like initially stalled the rally. We still closed that year at all-time highs. But what breaks that behavior now? I don't know what the answer to that question is. I think it's one of those things we'll see it. I have some things I'm watching for as risk signals for that longer term top. But for now, I think you're just sort of, you have to operate on the idea that dips are going to get bought. And you can watch vol, for example, and see that like puts just don't get bought when the market sells off. Like you just don't really see it, for example. So like people aren't necessarily interested in hedging, those kinds of things. So
it's interesting to me. Like this whole thing on time frame is really interesting to me because when you talk to different investors, like that's something you always have to keep in mind. Like for instance, you said earlier, you're really thinking with what you're seeing here, like on a 30-day time frame a lot of the time. Someone like us, when we manage money for clients, we're thinking on like crazy long-term time frames.
Yeah.
And then Doug is thinking, with his bubble thesis, he's thinking on like a 3-year time frame. So his thesis may or may not play out, but for you, there's a lot of 30-day periods between now and then that you're going to look at. So it's just interesting to think about everybody's kind of operating on these different time frames in terms of how they think about what they're doing.
Yeah, and I think that, there's a famous saying by George Soros about, when he sees a bubble, like he rushes in to buy or whatever it is. Like in 2021, the bubble kept going. I have a chart on that we can check out. The bubble kept going for, a big chunk of the year. And I think that it takes like to pop the bubble, you have to like break the behavior, you know what I mean? For getting valuations. And now you have, I think, so much more leverage that can be invoked by the everyday trader. Back to the Nvidia 2X ETFs and zero DT calls and all this sort of stuff that, why shouldn't we have a bubble that's bigger than all other bubbles, right? Just because of the leverage that these types of products invoke. I mean, yes, people can get in and out faster, arguably, than they ever could before. There's more electronic access and whatever, so maybe that tempers some of it. But I do think that the idea that things can get crazier than you expect, like that feels like this environment.
That seems to always happen. Like I remember in the .com, bubble, we got to like the CAPE, the cyclically adjusted PE ratio got to like 45 on the S&P, which was the highest ever. And a lot of people thought it would never go there because it got to 45. Right. But, if you look at Japan in their bubble, they got to 100 on the CAPE. So they got double the valuation of what the US got in the .com bubble. And they obviously paid a huge price for decades in terms of their returns because of it. But you just can't say, like, that's what's hard about these things. You can't say how far they're going to go. But also when they do end, probably the further they get stretched, like your rubber band analogy, the uglier it's going to be. And unless you think you're the guy, it's hard to be the guy that picks the top and like sells everything at the top. You don't know it's the top till after the top is over.
Yeah. And emotionally, it's very difficult to say like, this is crazy. I'm going to go on vacation for 6 months, because you sit there for 6 months and miss 20% upside and you just, you want to go nuts. And then you get in and the market sells off 40%. And, that's just those cycles are kind of as old as time. So as crazy as things go, like, the Nvidia thing comes up, and if Nvidia is like, hey, we just came up with this new thing, and everyone's like, holy cow, like there's another, whatever, $10-15 billion a month in revenue. And then Powell's like, hey guys, like we're good for now. Don't worry about it. Like, it's hard to believe that we don't go up, 5% more, right? By the next time we have this conversation. So, there's a lot of dependency, I think, over the next couple of days with these trigger points, like CPI tomorrow. If that's hot, and market's probably going to pay a short-term price. But then again, if Nvidia is good and FOMC is good, then, exciting and dovish, then we probably just repump, right? And that speculative behavior comes back in. It just comes back in at a higher price, which is bigger value swinging around. And, we just kind of repeat the cycle here. So it's going to be a very interesting week or two.
Yeah. And as we switch here to what's moving, I would say if we ranked like the titles of all of our various slides, this would be the most popular title given the environment we've been in, which is this record call volumes. So we've been talking about this idea a lot.
Yeah. This is weekly call volumes and weekly put volumes. And so this past week, we took out every high since November of 2021. So it's the only period that has higher call volumes, not premiums or anything, just pure volume. And then you can see puts are off the ropes, but a lot of those puts are being sold. In my view, and you could tell that by the way implied vol moves around. So, calls are like when you look at the options market, right, and you are looking for that verifiable sign that things have gone just a little too crazy. You look at that zero DT volume chart we mentioned before. Okay, now you got your record call volumes. And then, we could pile into some other charts that back this idea that, okay, like we're short-term, like really overstretched. This is data that comes from the S&P Global. We did a write-up on this. I put a link there in the slide. If you look at correlation, correlation tells us, obviously, in this case, it's comparing the components of the S&P 500 or the S&P mid-cap index versus the index itself. So what's the correlation of those components? And that's the red line on the left. That is near lows going back a couple of years, right? So what that's basically telling us, obviously, is that the components of the index aren't moving in the same direction necessarily. And that speaks to this idea of, poor market breadth or whatever, however you want to describe that. Semi-stock, chip stocks, and other things going. On the top is dispersion and volatility. So dispersion tells us how much the individual components are moving apart from each other, so to speak. So what we have now in this environment is a situation where certain components of the S&P 500 are going bananas to the upside, right? Not shocking. Nvidia goes crazy. Avgo goes crazy. Google doesn't do anything. Coca-Cola, I don't know what that stock is doing, but probably very little, right? If not down. So that dispersion move up is telling us that there's a lot of stuff moving. The individual components are moving. Linked to that is volatility, which is just the volatility of the index, which is not at its lows. It's fairly low, but it's up a little bit. So you have a mild stock up, vol up, but really it's not much. So you look at this and you go, okay, stuff is moving. The correlation is very low. Why does that matter? Well, typically what happens when you have a lot of or a high dispersion reading here is the market is crashing. So the period that you can think of is March 2020 when the world shut down because of COVID. All stocks went down, right? Every single stock in the world went down. Some stuff went down more than others. Cruise lines were marked at 0, essentially, right? Like energy was marked at negative. Hospital stocks were probably okay, or I think some gold miners made it all right, whatever it is. Like some things didn't go down as much as others, essentially what it is, right? So some stuff, so it all moved in one direction, which drove correlation up. So you could see the correlations at highs in that period. And dispersion moved up because, again, some components are moving. And then index volatility went through the roof, right? That like the VIX went, I think it almost hit 100, on an intraday basis back then. Like it just went bananas. So this is weird in that dispersion is moving and correlation is down so much. So why does that, what's weird about that? Well, the S&P Global, if you kind of dig through some of their white papers, they show you this chart, and this was updated by them last 10 years ago, but I found it and just thought, man, this looks so familiar. They have this chart of the VIX, which is in the green, and the VIX, as you can see, is flat right through this period of 2000, late 99 to 2000. But you can see that dispersion reading jump way up, right? And so when you think about the stock market bubble, the 2000s, the tech bubble, it was pets.com going up however many times that went up and yada, 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 like all those individual stocks, it was the internet bubble. That drove the dispersion reading very high, but vol itself didn't really move up. And so that's very similar to the environment that we have right now. Extraordinarily similar. And so that dispersion reading is a marked, you could view that as a signal of market breadth. You can view it as the rubber band being stretched. You could view it as, all of those kind of trader axioms. And just to read this is from their research, and it's from 10 years ago. They didn't write this recently, so I'm just reading what they wrote. But they wrote the period between April 1999, January 2001 showed a marked increase in dispersion driven by the deeply idiosyncratic behavior of the technology sector. But index volatility did not rise as sectors other than technology performed more normally. Thus, dispersion can better capture periods where only a portion of the market either bubbles or crashes. So, I just thought that like I could have, that could have been read today, right? I could post that chart, read that same thing today, and, it's verbatim. Super fascinating to me.
It's interesting. I mean, do you know if we're seeing we're probably not seeing as great dispersion as we saw in the late 90s yet, right? Or do you know that?
Well, I mean, it's a different market in that, there's way more trading vehicles and stocks and, so their dispersion reading in this monthly dispersion index here goes up to 15 to 20%. Like the dispersion reading right now is 20 to 25%. I don't know if they changed the metrics back then from how they used to calculate it. The components have all certainly changed of the index itself. We had the 2008 crash, which I think changed a lot of dynamics of things and, then on and on from there. So I don't know, to say that there's as much now as back then. I can't quite make that claim definitively. What I can say is that the S&P 500 level of dispersion is nearly as high as it was back to February of 2020, which you have to figure was an extreme reading in dispersion, regardless of which direction the market was going in. And if you look at the mid-cap level of dispersion, the only data point that's higher in the last 4 years is March of 2020. So, this is to the point before where, are we in stage 3 of the bubble or 5 of the bubble? I think it's safe to say we're in the bubble, but, at what point do you say, hey, I'm getting out of this thing, right? I don't know that it's over yet. I don't, who knows? That's the $1 million question. And also ties back to this, is this A top or D top?
I wonder, has anybody looked at dispersion versus forward returns, over a longer period of time, just to see what it means for forward returns when it rises?
It's an excellent question. I've not done that. I tried to get the data itself, to download from the S&P Global, and I didn't find it available.
It may not go back that far.
I think
I wonder if it might not even go back that long of a period of time.
Yeah, there's like huge gap in the data. So I think, if you maybe paid for it, you could probably get some stuff. I also think that they used to have a deal with the VIX and the SIBO, and they don't. It's like, again, the data changed all these years. I think with a Bloomberg terminal, you could probably like figure that out pretty quick, and it's worth investigating, and would be super interesting. This is from the CBOE. They launched some dispersion indices, which kind of have like like the correlation dispersion indices here are just based on stock movement. The CBO dispersion indices are somewhat measuring the same thing, but I believe they look at the implied vols in markets. So it's kind of like an options take on dispersion. And this came out actually today. So I jammed it in the presentation, and their dispersion reading here is as high as it's been over the last really year. It was a little higher in July of last year, but essentially what they say here, I put a quote from their lead analyst is Mandy Zeusch, who writes like great stuff. And, essentially what she's saying here, I'm paraphrasing, is that Nvidia implied vol and the other chip makers in some of these mega cap names are really driving this dispersion index higher. They are what's driving these readings to be just pretty crazy, right? And this is a shorter term chart. This is what they put in their morning note. And so, this is, again, this sign that there's just certain stocks that are really kind of blowing things out and moving things so significantly. And so this is the data that says, hey, these moves are anomalous, and how much longer can they continue? The problem in my view is that when you have volatility going up as the market goes up, well, when the stock pauses and that volatility stops driving higher as the stock goes up, that volatility is going to come down. So what happens when the volatility comes down? Well, I think stocks come down with it. It's the same thing. Like if the VIX spikes as the market crashes, if volatility comes down, all these puts lose value, and that tends to drive the market to rally up. And this is, I think this is really the same thing in my view, where you have stock up, vol up, and when that stock stops, it pauses like that zero gravity situation. Then we start to kind of come back down to earth a little bit.
This next one's interesting. So you're looking at 20-day moving average of tech call volume versus overall market volume, right?
Yeah. So I just looked at call volume. This is Nvidia, AMD, Avgo, SMCI, the top semi stock names. And what you can see here is a real breakout in call volumes. It's about 8% now of total call volume in the U.S. options market is these chip stocks. And this is just a contract basis, not premium. So obviously a lot of this is Nvidia, but you can't wave a finger at some of the things that have been having an ARM and AMD and SMCI either, right? Like this complex has just gone pretty wild. So this is about 8%. Just for comparison purposes, I showed what that similar metric looked like in FAANG plus T, which was like kind of the last in 2021, like that was the sector, right? Like by the FAANGs. And so if you look in 2021, those volumes peaked really in the 12%-ish. What's interesting is the highs of that as a sector came at the end of 2022. It was basically a huge buy the dip, right? In those names that were weakest at the end of 2022. And that turned to be 17 to 18% of the volume. But those are all the stocks that have the biggest market cap, right? I mean, you're talking about at the time is Facebook, Apple, Amazon. I included Meta in that FAANG, analysis. So it kind of makes sense that those top, 7 names or whatever they be would be such a large component. In this case, you're talking about obviously a much smaller subset of stocks. And it's really starting to see how that has broken out over the last 3-4 months, right? The amount of volume. So again, another metric here that tells you like how wild this has gotten in a short amount of time.
So does this next slide kind of give us some reason for pause here? Does some reason to think that this might be falling apart a little bit?
Yeah. So I had posted this chart of, the skew rank versus IV rank before, and I changed the axes a little bit just to confuse the crap out of everybody here. But so the bottom line of this chart means a lot of call buying, right? Low volatility, relative low volatility environment because earnings had passed by and large. And this measures 1 month options activity, and everything is very concentrated towards the positive 90th percentile skew rank, which means calls are very rich. It's a lot of demand for calls is what that's telling us. The most recent the most recent skew rank reading I have, that yellow blob would be up here in the top left on this chart. And what you're seeing is the shade of red has dispersed across this chart. It looks almost like a cloud or like a storm system moving now across as opposed to like a hurricane, basically. And so what this is telling us is that those call skews that were so concentrated across all names now, they're shifting where it's more about calls losing value now as opposed to necessarily bid to puts. So if you think about skews as ranking call implied vol relative to put implied vol, so calls are coming down in value. There's not necessarily big for puts yet, but those calls are really cooling off. And then we see implied vol rank starting to shift up. That's a little unusual considering that we just passed earnings season. So volatility is increasing, which can be expression of stock moving up or down. And that tight call skew that we had, that heavy call skew we keep referring, is breaking apart. Why would that be? Well, stocks are up incredibly, over the first 3 months of the year. Friday, was a real interesting, like earnings are behind us. Avgo, Marvoig, the last two that could really spark things, they didn't really turn up much on their earnings report. SMCI is about to go into the S&P 500, which I think is going to really tamp the volatility down to that stock, which was such a leader. Nvidia's got this event on Monday, but that's kind of the last hope for, I think, justifying another leg higher at this point. And I think that's starting to be reflected in that call implied vols have gotten so crazy that I think people are monetizing them. You also can't, like when you pay too much for a call, you can't make too much. And so when you're buying these record high implied vols or these, 90 plus percentile call skews, you could say you're paying too much, right? Like you're the guy who's buying the house in Florida at, 2006 in December or whatever, right? Like you don't want to pay too much for that house. And that's kind of like feels to be what's happening now. And so this breakup of skews is a signal to me that the options market in terms of supply and demand, that demand for calls is starting to fade. Now this can turn quickly, but it was a pretty consistent pattern before this. And this chart is really showing us that there's shifts underneath the hood.
These next two are interesting. So you're looking at this Nvidia event and you're looking at what's going on behind the scenes. This is a similar chart to we used in the last episode. What are you seeing there?
Yeah, so this is 1 month options. This is from Implied Vol dashboard. We just launched this, by the way. If anyone's interested in trying spotgamma.com, you try that out. But this shaded cone is the 10th to 90th percentile of 1 month skew readings over the last 60 days. So this included Nvidia earnings, which is a big deal, right? That always increases options implied vol a lot. And what you can see is that this 1 month skew, because of the event, you have what's called a very high call skew because, people are still very bullish on Nvidia. People, what could come of this thing on Monday? I don't know. It could be the God particle, of AI, sentient, whatever. I don't know. And people are leaning that way. And you can tell that because these out of the money calls have a higher implied volatility than at the money calls. That's a reflective of demand. And past performance, obviously, like stock keeps going up. And so odds are what's going to happen after this event is that these vols are going to come down. Like the call skew is probably going to flatten out a little bit, which means that the out of the money calls won't have such a high implied vol relative to the at the money. So like this is a steep curve, like a bike ramp. It's going to like flatten out to be like a normal road would be how you think of it. And then implied volatility just in general, Nvidia, I think is going to normalize. So, you could think of that as this entire green line really like deflating as that vol comes down. And if that happens, that's a sign that call demand is cooling off significantly as well. So I think the event will trigger like a release of what we call event vol that always reduces implied vol a little bit, but a more normalization I think is likely to come after this Nvidia event, assuming they don't pull, this incredible rabbit out of that, which they could. They blew out earnings in a way that people didn't expect. So when that happens, I think you see a broader deflation of call demand across the chip sector in general, which helps to cool off what I think is just an overheated short-term market. To sort of put some weight behind how much the chip stocks seem to care about this event. This is term structure in the SMH. And normally what happens is this plots at the money implied volatility by every single expiration. So when there's an event, that raises implied volatility at a given expiration. So what you can see here is that there's a very elevated implied vol related to the event on Monday. And then, implied vols after the event cool off quite a bit. You don't see the same structure when you look at other ETFs. Like, you don't see this in the Qs or spiders or whatever else it may be, indicating that the SMH, which is a big component of which is Nvidia, obviously. But this just indicates to me that like people are expecting volatility out of that specific event, kind of like an earnings date almost. And that's not necessarily driven by like CPI tomorrow, FOMC, next week. Like there's some bigger macro events, but when you compare the data, again, more broad-based ETFs, you don't see the same structure. And so that tells me that indeed, like this is the leading sector of the market, tons of call activity, real signs of exuberance across the options metrics, and, 90th something percentile. Those are, like that tells you objectively that stuff is all, extremely high. And I think the event really releases a lot of that energy and leads to a general cool off.
It's interesting. Like always when there's high expectations going into these events, they like most of the time, I think they end up being like sell the news type things. But then you get Nvidia like reporting revenue growth that's unprecedented, like at all time for a company of its size, or the event is like something we've never even thought of that's like going to change the world forever. And like, no one's going to price that in. So it's like, the odds are in favor of it not being that, but then they've tended to deliver these things that just seemed impossible.
Yeah, that's 100% right. And these things I think are reflexive in that, Nvidia pulled the rabbit out of the hat into earnings, arguably the last couple of earnings. And so, they're assigned a higher probability of doing it again. I don't know what the implied vol around was these events in the past. I think they do this fairly regularly. I bet that isn't this high. And so it's like the bar for Nvidia keeps getting higher at all these events. So at some point, it's kind of like the CPIs that we used to have, where the CPI print, like 2020, that was like the most important print that's ever happened in all of humanity. And everyone would be like, CPI, we gotta have like, Twitter meetings and calls about it and stuff. And at some point, people were pricing in, like 3% daily moves in the zero DT options. You measure how much the market was anticipating in terms of movement. It got to like 3% where you go, it almost doesn't matter what CPI prints at, we're not going to get that move right out of this. And I think when that happens, just like anything else, like when you overpay for calls or you overpay for puts, like if you buy puts when the VIX is at 100, it doesn't really matter what happens. You're probably not going to make money on that put, right? You're not going to make money on a call when you pay too much for it. It's just not like, it just can't happen. And like we're not at, I think again, this is not as stretched as it is into earnings. Like there's a great chart out there where somebody bought, they show the at the money call price of Nvidia into earnings. And even though the stock was up 15%, that at the money call was unchanged the next day because the implied vol was too high. So, this is the unwinding of that, or the cooling off of all that, I think has a dampening effect on the market. And, that's a correction. All signs here point to a correction is due. But again, it's Nvidia, so it keeps me ahead.
The day is going to come where they do not deliver what people expect, or don't deliver way above what people expect. Now, when that day is going to come, I don't know, but it's got to be coming at some point in the future.
Yes, I think so it's like SMCI vol, I think is going to come down. It's going to go to the S&P 500. All these other chip stocks, I think, are having a hard time now keeping up with SMCI or with Nvidia. And, it's like, so like inside the chip sector, that breadth seems to be narrowing. Like Avgo's returns just, after earnings, I think the stock was down. Same with Marvel, which is a semi chip stock, I guess. And so, it's like Nvidia is the only game left in town to keep dragging this thing forward. Stock's up a tremendous amount. The volatility is extremely high. The higher it gets, I think the harder it is to keep justified paying for those calls because they're just so expensive. And, it like leadership is dwindling. So, gun to head, you have to bet that, they know some cool stuff, but it's not like, we just tripled our earnings, unexpectedly, kind of cool stuff. And I think likely leads to some short-term correction. I think any dip gets bought because Nvidia is probably still considered the best stock of all stocks, and maybe rightfully so. I'm not here to say that. I'm just simply here to say the band is very stretched.
So just a couple more here as we wrap up. This is something we've talked about before, this idea of VIX expirations and the impact they have. What are you showing here?
Yeah, there are, we've done some research and highlighted certain moments in time where the VIX really wags the market dog. And I don't know if you remember, but this happened just after we talked in our last OPEX. VIX expiration was before options expiration last month. And there was this crazy day where the VIX suddenly went from 14 to 18. It just blasted off. And it violently reversed. VIX sellers came out of the woodwork and sold it off. A similar thing of slightly less magnitude happened in January, where the VIX went from, 12-ish in that neighborhood up to, about 15. So the last couple of VIX expirations have brought, I think, a lot of rolling. So that's traders who, are long VIX calls for this expiration. They roll them out to April, and that supply demand mechanic has opened up shifts for volatility to move writ large. And with that, you've seen some pretty big S&P moves. So in this case, we had the VIX 15-ish last time I checked. Right now, if CPI is who cares tomorrow, which is probably what's going to happen, then VIX probably comes down a little bit. But then VIX expiration is on the morning of FOMC. So you get a lot of weird movement the Tuesday of FOMC. So we're going to have the Nvidia deal on Monday. Then you got the VIX deal expiration, which has been a boost for VIX, at least in the short term, into FOMC. And it gets weird because there's always event volatility priced in around the FOMC itself. So do people really want to short VIX aggressively if there's any kind of spike into FOMC? So there's just a cadre of events that line up here where, forget your view on events, there's just a lot of position shifting. Vol's changing a lot of expiration. Remember at the top, we talked about this huge size of positions expiring. And so, I think these are times for turning points and really jumpy movements in markets that can, change the pace of change or lead to a shift in direction, at least in the short term. And so, these are all significant events. There's a lot of data here that, again, points to things being very stretched. And the trigger points for change are all lined up here in the next, call it, week.
What are you looking at on this last slide, this mapping out SPX time and price?
Yeah, the way that we distill all this for subscribers and readers of our analysis is like to just bake it down to simple price zones. And so, anytime we're mapping this out, we're considering two things. We're considering significant options levels, and then we're considering how changes of implied volatility will invoke movement in markets. So if you've heard of these terms of gamma, vena, charm, like we basically just bake all those concepts and boil them down into these easy to digest zones. So if you think about it right now, back to that original chart that I had of where the big strikes are positioned, we're in this very neutral kind of chop zone around 5,100. Maybe we go up to 5,150, but it's really in that general zone. And the options market positions are there. I think that over the next week, you have to consider that to be an area where we could shift up in that zone, but then just easily drop back down the next zone, back towards 5,100, just as a function of zero DTE flows coming in and out of the market, which move the markets a lot. And you need these bigger triggers to unlock higher prices, at later dates. So in this case, what happens is if we break 5,100, vol's likely to spike, even if it happens tomorrow, particularly in the CPI. And then I think we get enough of a vol spike and enough shift in flows that we immediately go down to 5,000, and that becomes the level to watch into FOMC next week. But if we go below 5,000, we're probably a little oversold, and I would look for a kind of a pinning back to 5,000. So that's the downside. That we have this, we call it the volatility trigger. Like you break 5,100, and it happened briefly last week, right? We went from 5,100, we just violently went down to 50 area, 50, 60 area. And then the next day, the dip got really bought, but there was a lot of volatility triggered by that move. To the upside, we have all these big call positions at 515 spiders, 5,200 in the SPX. And that is a resistance point for markets. And that resistance point is unlikely to shift until Friday's expiration in our view. And so, there's like this kind of, if you look at the distribution of prices, like there's the chance of like a little bit of drift positive here this week. There's a better chance that if we break 5,100, particularly if CPI is a little hot, that we could really sell off kind of sharply. And then when we transfer to next week, March OPEX clears out a lot of the positions. So volatility is more likely to come in, right? Their positions, since positions are reduced, there could be more market movement. You add in the Nvidia event and the FOMC. If we clear 5,200, we're likely to really shift up to 5,300 pretty quickly once we clear those events. And then to the downside, there's, like I said before, there's a little path dependency here. If we're in the 5,100 area and Nvidia is kind of a nothing done and FOMC is a little hawkish, then that downside can really open up. So that's kind of how we lay out this. Again, there's what I say is path dependency, meaning the timing of things matter a little bit. But this is generally how we're mapping out prices. So if you want to just state this another clear way, under 5,200 is like neutral, under 5,000 is risk off. And if we break to the upside 5,200, then that's a risk on, and then that's a real big signal that we're probably going to invoke another, significant leg higher.
Yeah, either way, with all the events we have between now and our next episode, we're definitely going to have a lot to talk about.
We'll have a lot to talk about. So, we can very clearly write on the side that Brent, we'll write it now. Brent is looking for some consolidation here. If that's wrong, then I'll say it was Jack that was calling for that.
Jack calls for, I'll put my tweet out. Jack calls for consolidation with no basis in fact, because I have no idea how any of this works.
Yeah. So it's going to be fascinating. There's a lot of big triggers that are happening now. And, I would just also say, like, if you're a longer term holder here, when you're looking at these implied vols, you're thinking about call overriding and things like that. I think that this is when it gets more interesting, when the vols really go crazy. They go to these levels that just aren't sustainable, and maybe you don't want to sell your stock, but these are the moments where, hey, maybe I want to buy some puts, or I want to put some collars on, or, different trades like that. That can help protect some of those gains that you've gotten over the last couple of weeks. Because, like, even though the VIX is high, like puts are not all that expensive. You can, yes, you can add some VIX hedges that, VIX is at 15, but, the fact of the matter is you've probably gained a lot in just the last couple of weeks. So, spending 1% or whatever it is on some hedges here into this next week is not going to be that much of a short-term drag on your portfolio, right? So I think that's the takeaway when you're not necessarily, when you have a view that's a little bit longer than 30 days.
I think that's probably a good note to wrap up on. For anybody who wants to learn more about the data behind this, you can go to spotgamma.com. For anyone who wants to follow Brent's insights, you can go to spotgamma on Twitter. If you want to just basically get podcast clips and zero insights, you can follow me on Twitter at Fractal Quant. And we'll see everybody next week or next month, actually.
Thanks so much, Jack.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.